upon the breakout, gold's going to make a new all-time highs.
Gold-backed ETFs seen inflows of over $5 billion.
$8.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin. Hey, Kinesis community worldwide, this is Shane Moran. I'll be your host for this week's episode of Live from the Vault. We have an exciting discussion today with none other than Andy Maguire. We're going to go right to talking gold with Andy Maguire, but I'll tell you, it's been an amazing roller coaster. You've seen the gold move up very high and coming down, and people are a little bit confused, but that's why we're going to spend a little bit of time asking Andy some very specific questions. I think you're really going to enjoy this episode. So let's go right away to talking gold with Andy Maguire. Over to you, Andy.
Shane, it's just great to see you again, and I enjoy these 2 weekly visits. We usually get something very interesting to talk about.
You've been all over the world in the last maybe month or more on all of these shows, and I'm not sure exactly whether it was Arcadia or whether you were on Sprott or whether you were on another show, but you said something really interesting that made me laugh. You said, hey, you know, the price is going up, but don't worry about these pukeheads. If they try to take the price down again, don't panic. They're going to try it. And I thought you were talking about me because I want to buy more silver. I want to buy more gold. But let's talk about, I think we can start off right here, is what is happening in the gold and silver market. It's been an incredible couple of weeks here.
Yeah, Shane, I know, and I know you. I've known you many, many years, and be a very, very, very keen buyer of silver. And a dip like this, I know what you're referring to. I know you were all in there. So, but look, I think to answer your question, now obviously the elephant in the room is, and it has to be called this, a rigged sell-off. And this was, I mean, we're recording this on Wednesday, but everyone knows this happened on Tuesday, and that was COT cutoff day. But look, I want to put this into context because we had a lot of people worried about this. Now, what I would say is, look, backfilling in a bull market is just par of the course, but the veracity of the sell-off in both gold and silver futures and the timing of it in thin holiday market conditions, evidenced with sell orders that clearly exceeded the CFT position limit parameters that you and I and everyone else is constrained to. They were exceeded. This telegraph, this selling event was 100% official in nature. Now, we'll talk about that a little more in a little while, but basically half of the course with specs on their heels, a siren of bearish media calls followed into dip buying this morning. You've probably heard them all. They're all questioning the top. It's all done. Gold's finished. I mean, essentially, this is nothing but what we've always experienced when there's a coordinated effort to throw the kitchen sink at gold and silver. Now, insiders, and I'm talking about the house, increased the borrowing costs for speculators to buy gold and silver futures. Now, these events are all in the official toolbox, and they're really well coordinated. Now, while the counterintuitive timing of a $600 increase in gold futures margins that kicked in today after a sell-off and into what is essentially a $200 drop in gold from its 1 week highs. Now, it's actually going to be spun, and I know no one's yet to come out with a reasoning for it. It'll be spun by the House as triggered because of an increase in volatility. Well, not really. It did not escape our notice that leading into the 3-week $200 gold ramp, which last week, interestingly, threatened to drive gold through the last resistance point before the 2,500 gold reset point. And I think this was a little too early for comfort. Basically, we had insiders into that ramp, clinging on to offside short positions into the $200 rise into last Thursday. Now, the House did not dare to pull the financing rug from stretched out naked short positions until an official intervention would be arranged. That is what's happened. This was implemented into a sleepy, thin holiday market conditions yesterday. However, for reasons I will explain later, we will see this increase as too late as most specs were actually rinsed out yesterday already.
Well, Andy, I'll tell you something. This week, I've been getting a lot of emails, a lot of questions about the CME. I wanted to ask you about this because, yes, I talk about gold. We follow gold, but in particular, I like silver. That's just who I am. And I know a lot of my friends and a lot of people that I'm communicating with are into silver. And there's something here about the CME that is raising financing costs on silver futures. Can you explain to me and all the viewers, of course, but in particular to me, what does this mean exactly?
Yeah, so it's interesting. I mean, so we just explained how they don't raise margins when the shorts are struggling, but they raise margins when the price drops. Now, interestingly, there was a large this is a big one, a large $1,750 increase in SI margins, i.e. the cost of finance a position. It went up from 11,500 to 13,250 per lot. Now, what that illustrates to me is the CME is pandering to the offside casino insiders who've been called on for physical delivery of a product they cannot buy or deliver at current price levels. Now, we've gone on record in recent interviews how, as wholesale buyers, we're having to pay for heavily rationed wholesale 1,000-ounce silver bars for delivery as far out as 3 months. And I'm talking about not what we want, but what we're being restricted to. Now, this is ludicrous. And it tells us the reason this bullion is not for sale is it's too cheap. It's as simple as that. Now, clearly, in a fair market, this is not rocket science. In a fair market, if all this overhang of physical demand does not raise the offer to sell a price to a price level where an equilibrium of supply-demand price is settled, then it suggests bullion on hand is likely rehypothecated. Now, we're not talking about refiner delays here. We're drawing attention to the bars, these bullion banks who are represented on the CME exchange, which we've just referred to, who claim to have this bullion on hand. They cannot deliver. Everyone close to the wholesale market knows this bullion is in massive short supply.
Wow. Well, Andy, as someone who is really close, I guess, every day into the wholesale gold and silver markets, can you maybe just talk about why you think that this push down, or whatever you want to call it, is going to ultimately fail?
Absolutely. And so that in order to do that, you need to we need to understand what exactly happened yesterday. Now, while we have absolute verifiable evidence of very strong, fresh institutional funds flows actually moving into gold, and there's lots of evidence of this, and a lot of people, fund managers, are coming on, and Bloomberg, etc., and saying, yeah, we're seeing this. We're actually interested in investing in silver and gold. Now, we separate. What we have to do in order to analyze the market is separate these positions from the overall long positioning, because in a rising stock market, which they're essentially hedging into, these positions have no stops. So really a situation like yesterday did not take any of these guys out. Now, the reason that these positions are that they weren't taken out is because they're secured to hedge into a high-risk ballooning stock market, which is, we know, it's driving to all-time highs again, into enormous risk. Now, these are really high-risk positions, and there are really very few employable hedges to complement or indeed replace treasuries, and gold is the preferable hedge here. And that's what we know this simply from the positioning and the lack of flush of those positions. Now, this is why it's important to separate these institutional hedge positions against the flows of straight up speculators who were up until yesterday chasing what was a parabolic short squeeze higher. Now, these speculative momentum driven positions, they have visible stops. They are on the books of these same market making insiders who do the financing for these guys who buy them. And they know there's never going to be a delivery. And these guys are heavily margined. So really, you've got two things. You've got a sudden increase in margin costs, and you've got a market which has suddenly been chart painted lower. And so really, they became the target. It was this group that became the target for the what essentially officials are trying to do here is slow the rise in GC and SI, in gold, in other words, gold futures and SI. And these sort of raids are not random. And it's really careful. You have to understand there's a calculation here that is absolutely surgical. What it is how much short cover is there that can be rinsed out in the futures market versus these same market makers' exposure to what is a T+2 delivery demand in the over-the-counter markets. T+2 meaning they have to deliver within 2 days. Now, so really to finally put this raid into context, once this sell ignition was triggered, specs turned from long to short and are now, and I'm talking about these are the speculative guys, and are now on the bearish side of the bets insiders hold the long side of. This is an age-old game, and they've suckered for it. Now, this began to be evident well above the silver futures low, and the silver futures low as of this morning in the Asian early hours was $23.58. In the gold futures, it dropped as far as 1874.20. So in other words, what the optimum balance was achieved between delivery obligations capitalized on in the delivery spot market and what can be rinsed from speculators from the COMEX. And it has to be borne in mind that on the other side of the targeted rinse of COMEX speculators are the delivery obligations accruing in the larger over-the-counter spot gold delivery hopper feeding in, which so far can be offset by what is rinsed out. But with stocks testing all-time highs, again today nearly, in very risky conditions, fresh risk-on related hedging flows continue to flow into the gold and silver futures. This makes it very difficult for these officials to get downside traction. So drilling down, notable was the inflow this morning of 66.6 tons into the SLV ETF. Now, this was priced at yesterday's silver fix. This occurred just before the $5 smash. And considering that there's 5,000 ounces per contract, that's a big deal. While what we saw was GLD today, evidence outflows into the P.
Wow, hey, Andy, that's a lot of information, and I think our viewers are going to be very happy they tuned in to this call. But I'm not sure if you're able to share with us, but just before we started recording today, Andy, you mentioned that you had some breaking news, and you mentioned something very important that you heard about what's upcoming in the gold market, or what's happening in the gold market. Can you just maybe talk a little bit about that?
I think really on the subject of GLD, I'm hearing that this bullion outflow was, first of all, that was needed elsewhere. And the smash essentially made it $100 cheaper per ounce to buy. In fact, this jives with credible evidence from last week, which I haven't made public yet, from an extremely undoubted, well-connected bullion bank desk, and I'm talking about a big bullion bank desk, that the Bank of International Settlements has been swapping physical for unallocated gold. This has not happened, in my view, for 3 years. This, why you ask? This serves two purposes. One, it fills this embarrassing shortfall in available inventory, which is earmarked for physical delivery. So in other words, everyone's questioning, well, where is all this gold coming from that's going into GLD? Where's this gold coming from that's going into registered inventories? Where's it coming from? If we can't get any size ourselves, where is it coming from? There's your answer. But the second thing it does, it actually sets up officials for the revaluation setup that we've been describing. Namely, insiders are structuring long foreign exchange gold and silver, and that is the only way a paper to physical price reset can be squared. So everything suggests the lines cross with this reset, at this reset at 2,500 spot. And I can upgrade the silver price. It was $35 in silver, and that will be achieved, and before the reset. Now, it's not possible to default, and people need to understand this, and especially when COMEX-centric, from a COMEX-centric view, and you're not allowed as a US citizen to trade the foreign exchange cross of gold and silver, which is ludicrous. But essentially it's not possible to default on a foreign exchange cross, which is gold and silver. Gold and silver are a massive component of this. It makes total sense to essentially spot index long gold, short dollar positions. Now, which we know can't be delivered in the size we want, but it will ultimately be deliverable at an equitable price. And this is exactly what the BIS is doing, and this is what the insiders are doing. Spot indexing provides the ability to lock in a price today. It doesn't matter what the revalued price settles at, i.e. where the true supply-demand fundamentals do finally balance, as one is indexed to a number of ounces, regardless of that price. So whether that's ounces, kilos, or tons, it can be demanded for delivery at the indexed price. So really, to keep it simple, if you're buying it today at 1900 and you spot index it and it rises to $3,000, you still have the right for that number of ounces to take delivery at the price you locked in at 1900, even if it's trading at 3000. So that's how spot indexes work. But so fundamentals really, it's important to look at the fundamentals. They're really disrupting the decades of old guard suppression game. Now, given officials have spent decades on the other side of the fight, adding massive swathes of undeliverable paper supply, and that's complemented by officially shorting gold against the dollar and rewarding those who followed it with a positive carry to do so. Whereas we've said this a few times now, and it's very important to remember what broke on the 23rd of March, that trade turned on its head and the paper market lever broke and the short gold trade flipped right on its head. It's actually now no longer a profitable trade to short gold like it used to be. So what this means is that gold will not only rise relative to the dollar's diminishing purchasing power, but the mechanism to contain it has broken. So we're now evidencing two major drivers to revalue US dollars priced in US dollar price gold. So gold's going to have to catch up and keep pace with the trillions of dollars of dollar dilution, which is still flowing in, and it's still flowing in out of a loaded hopper, which just keeps getting loaded with more, but also deeply depressed physical supply-demand fundamentals are about to uncoil, and officials will be forced to allow the dollar price of gold to be revalued. And these insiders are already long for their own books, ready for this valuation, as are we, and I hope as are you, in physical form. Now, so drilling down into the current footprints, what it does is enable us to both validate the major, yet under the radar, change in market behavior we're witnessing. Now, yes, it seems like there was a big smash yesterday and all is lost. But ultimately, we're in the process that will result in the emergence of a real physical price. And by observing these unfolding footprints, we can time some interim moves, and which is why we're trying to have these regular updates so that we can guide you, hopefully, to not make a bad decision.
So Andy, while we're with all of that said, I know that and here, especially at Kinesis, we exclusively talk about physical gold, physical silver. We're not talking paper. We're not talking what if or maybe, but can you maybe just share with us what you believe would be the fair value of both physical gold and physical silver today?
Yeah, and that absolutely, and that is a tough question for anybody, even if you are connected to the wholesale market. But I think, given what we've just described, given the two parameters where you've got a physically deliverable price, even if it's done in the paper market, that really is, it's really important people understand. You can't just take a price to zero. You can't just chase a dot to zero and say, well, that's the price, because it is physically deliverable. Now, so here's where we are now. The unfilled physical orders and what we can't get and what many of our other, even second-year banks cannot even provide us with, these unfilled physical orders telegraph the price is ultimately too low. It's as simple as that. And with this realized, it drives even more bargain hunting. as would be the case in any commodity which is in short supply. And since the exchange for physical conduit broke on March the 23rd, which is primarily the reason that it broke, the inability for these insiders to create limitless quantities of paper, silver, or gold in order to settle paper, silver, or gold delivery demands by simply creating sufficient paper contracts to square the books has resulted in an enormous spot index silver position building up as in the yet to deliver demand hopper. So in summary, what we're saying is, what this tells us is that the prices have to rise significantly to empty what is stacked in this demand hopper. But it's a catch-22 process. A rising bull market draws in even more demand. And after years of coiling in grossly suppressed price levels, this can only be resolved by a very large upside price balance and subsequent overshoot. So ultimately, we're going to see silver overshoot its real value at some point. But let's look at that. Let's look closely at that. The only question is right now, what I get is, at what price point would freely available silver bullion be available? Is that $50 or much higher? Now, the historical gold-silver ratio is widely accepted to be around 16-1. And given that 2,500 gold is now the minimum price forecast, this is an absolute minimum. That puts silver at a minimum of $150 per ounce. I know that'll make you happy. It'll make Bill Murphy happy. It'll make a lot of people happy. But as we've noted, after such a mismatch of unfilled paper to physical orders, this price likely actually overshoots to the point where there is so much more physical bullion sellers than buyers, and a real fluid physical price will ultimately be crystallized. And that's all we're asking for, a fair market price. And all the liquidity providers and trading banks we speak to are expecting the paper market derived price to continue to catch up to the true supply-demand fundamentals, and the overhang of physical orders yet to be fulfilled continues to build and telegraph that underwater naked short positions that are being called upon for delivery will force even more short covering. So this pullback is just a step along the way. So really, a final summary, the exact same situation is evident in gold as we just described in silver. It's not plausible that inflows since the EFB conduit blew up on March the 23rd comprise of unencumbered real physical bullion. From all we can assess through our close ties to the wholesale market, at the 2,500 spot gold price point, insiders will be positioned and ready for an upside revaluation. Wholesale market footprints evidence that this is what the first-tier banks are doing. And clearly, we're not far away. We got very close. I think they stepped in, it was too quick. But when you backfill like that, and you wash out the fluff, as we would call it, then now you've got the real money, the unstoppable positions, the physical guys are in there. So we're on our toes. We're watching carefully for these footprints as gold starts to migrate into the 2,500 and silver in the 35s. So, you know, just remember, we always have to remember, spot gold and silver will continue to be T+2 deliverable and valued at a level where sufficient real bullion will be offered at market to really reflect real supply-demand fundamentals. So it was a bigger answer perhaps than I was hoping for, but you have to look at the whole picture here.
Awesome, awesome. Well, I want to thank you, Andy, for your time. This has been an amazing call. We can go on for hours and hours and hours, but we'll conclude the call and we'll conclude this episode of Live from the Vault and Talking Gold with Andy Maguire. I appreciate everything, Andy, and the information that you're bringing to all of our community members. And we look forward definitely to the next 2 weeks in our next call. I'm sure there's going to be some awesome updates. Thank you so much, Andy.
Oh, it's a pleasure, and I really enjoy our entire community.
And that's this week's episode of Live from the Vault. We'll see you next time on Live from the Vault. Bye for now.